Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, September 9th, 2021. What I'm going to do here is do a very quick update on the near-term outlook of the equity markets, and then we'll just look at two couple indicators that speak to the longer-term, really call it conditions more so than outlook, but whatever word you want to pick there is fine. So we're going to look at the put-to-call ratio in the skew index and margin debt. And so a few, again, more of conditions in the market than actual indicators or timing indicators, I should say. All right, then I'm going to roll into some of my favorite trade ideas. Remember, the markets, do what you want with the markets. I update these. I'll provide analysis just because that's what I usually do to start out. It is certainly not where the easy gettings are right now. They're grinding higher, so you're making marginal gains if you're long. And again, there's not swing trading opportunities. That's what the primary focus of this site is about, catching swing and trend trades. And right now, we don't have really a lot of volatility in the S&P 500 to swing trade. Now, let me show you what I can tell you here. This is the SPY 60-minute chart, and we got a sell signal just last week. It was far from impulsive, so not what I want to see as far as impulsive selling on the breakdown nor on the follow through. But as I said, then I'm going to call it for what it is. It's the break of the trend line that I was waiting for. Then we took out the minor support, which we're just a hair above now. We'll see if we close the day or in the next 60-minute candle, see if we close above it. But I'm going to just say we're still on a sell signal for now. We're still below those trend lines. But again, not going anywhere very fast, just kind of stair-stepping down very, very near term, if you want to call this the micro trend. In other words, zigzagging like this down. All right, so what else do I see here? Well, number one, it's probably the most important thing here, other than that recent breakdown. Today we're moving back above that minor support. That's not ideal. Call it what you want if you're short. But what I wanted to point out here is let's look at the RSI for a second. Remember, we've been in a extremely resilient uptrend for a while. So what I'm going to do here is circle something that's super simple yet super effective, and that is the RSI, which tells you how overbought or oversold a security is. We're on a 60-minute time frame, so keep that in mind. This isn't a daily chart or anything like that, but these indicators and what they tell you, kind of the clues you can glean from these indicators, whether they're indicating a reversal, a bounce, or a pullback. It's typically commensurate with the time frame that you're on. So by that I mean an oversold reading on a 60-minute chart is good for the next, let's say rally for a few days to a few weeks typically, and usually measured in single, sometimes double digit. Again, it's all relative to the security. This isn't natural gas. Natural gas, you get a buy signal or something like that, you're looking easily double-digit gains on even a short-term swing trade that might last just a couple of weeks. Whereas the S&P 500 can take sometimes years to post double-digit gains when it gets stuck in a trading range. All right, so that's that. Because you have, remember, 500 different companies in here at any one point in time. Some of those 500 companies are going up, some are going down, some are going sideways, and that's why people like to invest in it, because you're very diversified in a lot of different stocks and sectors. Okay, back to my point. All right, so we had a divergent high here, and these divergent highs, I'm going to circle them all. Each and every one of them, without fail, was followed by a correction, and they've been relatively minor corrections because the primary trend is still bullish. So I'll point out these are good for pullbacks. If that's all we're going to get, that would be the smallest drop, especially considering the scope of the divergences here. So I still favor a much bigger drop. I'm going to maintain these targets despite today's kickback. Again, not an all-in trade, not my highest conviction, but there's the same targets I laid out for you. Okay, back to what I was talking about here. We're going to look at the RSI. So now, if you take the other side of things, you just want to buy dips because we're in an uptrend. You don't care to short right now. Well, look what happened. We just hit that 30 level. That's this blue line right here. 30 is typically the default on most charting platforms to denote oversold, whereas 70, the red line, is overbought, right? Now, in a bullish trend, I talk about this often, you don't short or sell or get out of your positions and overbought. Why? Because overbought often becomes more overbought. You stay up there. Actually, you hit it right here. You stay overbought for an extended period of time, and or you become much more overbought. You go well above the 70 level, and that's typical again of a bull trend. And in a bull trend, oversold readings are usually very fleeting. It's usually one and done or very brief, and that's your time to go long. So I'm going to point that out, and that's what I'm doing here, is that we just hit oversold. And just like I showed you each and every one of these corrections before, look where they ended. Oversold at the bottom of it. We're oversold right here. There was your divergent high right here, your correction, and it ended exactly with that oversold reading. Divergent high, correction, oversold. So zero failure rate here lately. Although right here, look, you did hit it, and you had another leg down for a roughly equal low, but again, that was also oversold. So you get the point. In a bull trend, it's usually one and done when you hit that. Now, okay, so where am I going? This is confusing now. Since Randy, you just said it's a sell signal, you're going to maintain your price targets. This never lasts forever. Sooner or later, when conditions build up, you get a trend reversal, and then this changes. So all of a sudden you get a trend reversal, the bull trend ends, and then what happens is oversold tends to become more oversold or stay oversold for an extended period of time. So with that being said, I'd be remiss not to point it out. There's another oversold reading, and so that's where we're at now. So again, this is why I just can't issue a hard sell in the market at this point in time, but take these signals for what they are. And again, based on the scope of these divergences, I would be surprised, but not shocked. Definitely not shocked, but surprised if this 1% or so pullback was all we're going to get out of here. So again, I'm kind of override based on everything else I'm seeing here. I do think this oversold reading, there's a decent chance that it's going to become more oversold very soon. We're going to take another leg down and at minimum hit my first target. And I'm still, this is still my preferred current target. And it's not even that big a drop. If we get down to 436, you're only talking about from where we're at now, about a 3.6% drop. So that's SPY. Enough on that. There's QQQ, same thing. There's a breakdown, and the selling has been anything but impulsive. We're kind of just locked here sideways now since the end of last month. There's the 30th right there. We broke down, not going anywhere, but now we do have this little minor support there as well, or that little small trading range on QQQ. Target's still 369.50. And then the bottom of this range, we'll call it about 361, let's just say, for T2 there. Okay, and most of the long-term indicators and conditions in the market that I've talked about for a while are still where they're at. In other words, we have just about every breadth indicator out there showing divergence, and we continue to see that. In other words, we have more and more lifting by the top-heavy FANG stocks, market-leading stocks with the biggest capitalization, Microsoft, Amazon, Facebook, and the likes, holding the market up while quite a few, and I did this just yesterday, I didn't do it in the video. I looked, and you can do this, go down to the smallest components, the bottom dozen or so in the NASDAQ 100, and you'll see that the vast majority of those have long since peaked, whether it's just a couple months ago, sometimes a year ago, and they're well off their 52-week highs while the market is at a 52-week high, and that's again due to that more and more money funneling into those big mega cap stocks that have the highest impact, the biggest weighting on the index. And again, that's just, historically, it's never been a healthy sign when you see that. In other words, fewer and fewer companies are making all-time highs, and that's again shown by the breadth indicators. And I just did that a week or so ago, video on that a couple weeks ago. All right, here's another one I've talked on for a long time, and I'll tell you, this market they're all different. This one is almost unique in the fact that I've rarely seen so many of my more reliable longer-term indicators showing in extreme, for example, extreme bullishness as measured by all the sentiment indicators, put to call ratio and other sentiment indicators, and yet not playing out. This is one of my most reliable, goes back for all the way back into the previous, 2007 bull market back there, the correction that came afterwards, the bear market, and you just have these tags on my level here. I have about 0.38. And every time we've seen the put to call ratio fall to that level, most points in time, well, actually every point in time, it's been followed by correction. Now, this one's not over. I've talked about this. And I've been talking about this thing for, gosh, what, a year now? And that's because we've hit it. And it's not that it didn't work this time around. It's still that signal, if you want to call it, again, for lack of a better word, because it's not a timing indicator. It's conditions in the market, excessive bullish sentiment, and we're still there. We're still right off the bottom. This is a cluster of readings, and it's just basically persistent bullishness as measured by the extreme in the put to call ratio. Guys, if you don't understand what that is, that's just a lot. When the put to call ratio is very low like this, a lot more people are buying puts because they're bullish, betting stocks will go up, than are buying calls. I may have just said that backwards. Let me make clear. Okay, put to call ratio. I'm sorry. When the put to call ratio is high, a lot more buying puts than calls. That means fear, and that's when you want to be bullish. Other way around. If I might have said that backwards. This is the extreme bullishness is when there's a lot more call buying instead of put buying, and that's what we've seen for a while. Now, keep in mind, this one is also the equity only put to call ratio. You can have, we've seen different things on the index put to call ratios. We're going to look at skew, for example, and skew is often measured more by what the institutional traders are doing. So we'll get to that one in just a second. Yeah, let's just jump over to this right now. So this is the CBOE skew index. And the skew index, you can look into it. It pretty much, it's been historically a measure to warn of potential market crashes, big moves in the market, and it also, like a lot of these indicators, uses put buying, call buying, things like that. And so this is really, I think the best takeaway from this is when large institutions are hedging up to protect downside risks in case of a sudden swoon down in the market. And so all you have to know is pretty much when the skew gets this high, here's things back there. You can see little abbreviations: Asian financial crisis, the European debt crisis and falling euro, Brexit, and all this other stuff. So you can go here, and this is on CBOE's website, cboe.com, and then just search for skew and you'll get this. Okay, so what I want to talk about, well, look at, this is typically the high end of the range up to that point in time. Remember, market conditions over time change. Different things happen. This is we're in unprecedented, uncharted waters. Never, ever, ever, even close in history, has there been so much government intervention in the markets with the central banks. And that started back here, back really in 2008, and then it just kind of increased as time went on. With uber low interest rates, excessive money printing, and other measures, extreme measures they've taken. But okay, so where are we going? Look at back here what happened, and you can see this is the dot-com bubble. If you guys remember, if you're old enough to remember or you've read about it, that burst in March of 2000, and skew peaked right here just before that. It had a peak. So this is when typically they're going to give you ranges when you read about it. They'll tell you when it's above 100. I like to look at what's going on at that point in time. There was a pretty good correction there in the market, right there, back in 2006, I think it was, 5. But skew stayed very high, at the high end of its range. See right there, up until 2007. The market peaked in October 2007. That was followed by one of the biggest bear markets in history. Well, 56% of the S&P 500 got wiped out in a matter of less than 18 months, and a great recession. And again, skew warned of that at the time. We had, of course, it shows you here some of the things that jarred the markets. These were big corrections along the way. And then you can see skew has just kind of really started stair-stepping higher. And again, that's just a function of different market conditions at different times. Remember, you go way back here, things were different. You didn't have as much high-frequency trading, algorithmic trading programs, things that are in play now. It's just different market dynamics. So you have to look at skew Here, we'll go in here and zoom in a little tighter. Let's do this. Okay, what I did, I zoomed in a little tighter here, and okay, so you can see skew started back in again. It did, been moving higher in recent years, the peaks of it, but really it started to hit these peaks right here in late. That was late 2017, right there, and then a much higher, big spike right there. And that was, here, let me put the crosshairs there. That was right around, it stayed high until about August 2018. And again, there was a peak there towards the end of 2017. Now, let's pull up the S&P 500. Let's remember what happened there. There's the end of 2017 right there, the beginning of 2018. And there was a big drop. That was a double digit, easily, well over 10% drop. And it was a very quick drop, almost a flash crash, very sudden drop. These are weekly candles I'm on, guys, by the way. And then there was that even bigger spike. Remember, that was right up until August. You guys remember well, I do very well, the Q4 drop in 2018. Media was baffled as to why it happened. There were a lot of technical signs indicating, we were able to catch the top on it, get a sell signal right when it happened, and the markets fell about 20%, over 20% in the fourth quarter of 2018. Again, kind of given a heads up by the skew. So there is some predictive value, and there it is. There's that big spike in elevated high. Again, not a timing indicator. You can't just, and there's no hard top anymore because it's been stair-stepping higher. All I can tell you, and then I'll get off this indicator if I've already bored you with it, we're at unseen levels. We've never seen the skew this high in history. Again, unprecedented times. Just something I wanted to point out, and it's more so talking about market conditions right now, because typically when you have these extreme spikes in the skew, historically those have been followed by periods of sharp corrections and/or bear markets. And last one, then we'll get off this and I'll talk about, again, where to make money right now, because there'll be money to be made when we finally get a decent trend reversal, whether we can look to go long at a bottom pullback to support or put on some swing shorts. Unfortunately, right now I can't put a hard sell on the markets, but these conditions continue to build, so I will update the markets on a regular basis, as I always do. This one is just it speaks volumes to me. This is the FINRA margin debt. So this is margin debt. That's when you open a margin account, brokerage account. You're borrowing money from your broker to buy stocks. And in bull markets, what happens when things are going up? More and more people start getting into the market. Those that weren't actively in there get in. New people open brokerage accounts. People who used to trade maybe got burned in the last bear market finally get the fear of missing out, and everyone just starts piling in. And at some point, or it's a gradual thing, it happens over time. People are like, well, heck, I just made 13, 15, 20% in the S&P 500 last year, my index fund or my stocks. At that rate, why don't I borrow? Interest rates are low. I'll buy stocks on margin, and that's how it works. And so it's pretty simple stuff. And this is not, these charts aren't twisted to show you what you want to see. You can find these from other sources. This one's from Advisor Perspective. But you can see that margin debt and the stock market typically go up almost hand in hand. Look at the red line, which is margin debt. Look at the S&P 500. And then towards the end of a bull market, margin debt starts going almost parabolic, or at least near vertical. Just more and more people piling in, buying stocks on borrowed money. And it works great when the market's going up. You're leveraging your returns. If the S&P goes up 20% and you buy, you've doubled down on margin, you have 100 grand, but you put 200,000 in the S&P 500 fund, SPY or whatever, you just made 40% return on your money, because you only have 100,000 of your money, but you had 200,000 committed into the market that did 20%. So you're, off that, doubled your returns, and that's how it works. Now, what happens is, and this is, again, it's just a cycle that has repeated itself time and time again. Margin debt spikes. And then you have bear markets and corrections. And it's that unwinding of the margin bubble. If people don't understand why in a bear market valuations get so cheap, why stocks drop so much, this is probably one of the biggest components of that. It's that unwinding of the margin bubble. So, okay, I've talked about this, and I'm not the only one. This is a well-known thing. But what I wanted to point out is that we've seen, and this is a fairly recent chart. I think it was through August numbers. We saw a noticeable spike down. See this spike down in margin debt. And that is typically when you get in that final stage of a surge in margin debt, it's usually a pretty straight up ride until you see a sudden drop. There's one right there. There's one right there. Again, after a trend of just almost straight up, there's one right there. And in each and every instance, that drop happened first. There's the market peak. There's the peak in margin interest. There's the peak in margin, or I'm sorry, the S&P 500. And remember, this is a year. Each one of these represents 1 year. So we're talking a few months there. In fact, they give you the numbers. There it is. Oh, yeah, they do it for you. Oh, that's even better. Margin interest peaked on March 1st. We'll just say March 2000. And then in August, the stock market peaked. Margin interest peaked in July of 2007. The stock market peaked 3 months later in October of 2007. Margin interest January 1st, 2018. Stock market kept going up until December 1st of so almost a year in that case, but then came that 36% swoon down when COVID hit. But you can see that the trend had already changed. So there was a predictive value. In the predictive value, again, if the pattern repeats, it's not an all-in thing. It's not a timing indicator. But once you see a noticeable drop off, and yet the market's still going up, again, historically, that has been the precursor to really, in this case, the end of a bull market. So call it what you want. I know I've been talking about that for a long time, but this is what I do. I analyze this stuff and share it along. And so the takeaway might be, if you continue to see this fall, and the market holds up, continues to rise, or even if the market starts to roll over and you start to see this continue down like this, again, you haven't seen a big drop like that without a major top in the market, at least going back into the 90s here. So it would tell you something there. Okay, now on to where I think we can make money, right away, actionable trade ideas. Yesterday, I passed along corn and wheat as trade setups. And again, if you're new to the site, I know I say, if you've been here a while, you hear the same things over. There is a colossal difference between a trade setup and an actionable trade. Yesterday, corn and wheat were trade setups, solely pending on a breakout above the downtrend line, the bullish falling wedges. I'm going to revise that. I took positions this morning because we're down to support now, so I think it's an actionable trade. We still don't have the breakout. There's two ways I enter a long trade. I either enter on a breakout above a bullish chart pattern or resistance level, or on a pullback to support. And so we have today, as of this morning, the latter, because since I posted those setups yesterday, we went down a little bit more and we've hit support. It's not a hard support level, but it's enough for me. I'm starting to scale in. I took both corn and wheat futures today, and we'll add to them if we break above the bullish falling wedge patterns. Probably should give you an additional target if you're into futures. I'm going to get to the ETFs in just 1 second for you here, or the ETNs, I should say, to be more precise. First target is going to be somewhere around here, give or take. Let's just make it conservative. It's more of a zone, but I'd say 526.50 or somewhere around there up to about. I'm just going to give you one more line in case you are interested in this. There it is. So that'd be your first target zone right there, and then all these lines are potential targets as well. That is a 3-month, 60-minute chart. Now I'm going to jump out to a 6-month chart and show you what I see here. This is the support level I'm talking about. We had a major reaction low right here, major reaction low there. We had a brief spike through, but see that green candle? That means we dipped down and reversed quickly, put in a major bottom. We rallied all the way up here till we had a divergent high. So if you look at it this way, here's what I see. I see a big trading range, consolidation. You say what you want about where you think commodities are going. I'll say what I want, but you cannot argue that they're not in a bull market. We know that the commodities, just about all ag commodities, are in bottomed a couple years ago and have had substantial gains, and most, if not all, have taken out previous major reaction lows. In other words, they have all the makings of an uptrend, and and so I view this as bull market consolidation. We're in a trading range. We have been for months. Corn and wheat and a lot of these ag commodities had a heck of a run, and so this has been the MO. Bounce around. It's not a perfectly defined trading range, but you can see, and that's why I have these lines here. There are support and resistance levels in the middle here. 530, that's about 539, that's about 570 right there. So those are your swing or trend targets if you're interested, and it's simple, very simple stuff to me. Long here at support with a stop not too far below, so consider this an active trade. Consider these price targets. If you don't trade futures, I'll get to the corn ETN in a second, and that's it. So there's my case for being long corn, and my case will get even stronger if and when we pop these 60-minute bullish falling wedges in corn. I'd like to see wheat break out as well. Corn tends to move more, but that's why I like to take them both if they're both set up bullish, and they tend to move together because they're competing or alternative food sources. And they also tend to grow roughly in the same climate. It's not like coffee growing down in the tropics. Corn and wheat are grown in temperate climates. So you have on wheat, which I just jumped to, this is a 2-hour period chart, so 6 months of 2-hour candles, and there's a major reaction low right there. That's where we're at. We're at support. We did pop a little below it there, but I see enough reactions around that level. It's not the best defined support. Corn had better support. Wheat has really good support down here, and this is a possibility. Look, guys, so this is why I don't get married to a trade. We may break down in wheat, come all the way down here, and if we do, I'll be stopped out of this trade, but I'll be long back here, especially if the charts confirm. Like right now, we have positive divergence, and to me, this is simple stuff. I don't try to overthink things. I do analyze the heck out of it, as you probably know. But it's pretty simple. I've got positive divergence oversold at support, just like I had positive divergence right here, and that was one of the biggest moves in months right there. Positive divergence here. You can see all my divergence. Positive divergence there at that low, and then same thing. Negative divergence here, negative divergence here. And that tells you to get out or get short. So that's the swing trading. And these are the things I look for. I'm marking this chart up all crazy, but these are the swing trades. And a lot of these, so all the big moves were foreshadowed by positive and negative divergence. Often, all the better when you can get a positive divergence at support. So while we don't have a buy signal via a breakout, we do have a pullback to support. And now let me zoom down to the 60-minute chart for you. And there's what it looks like. ZW wheat futures right there. So could head a little bit lower. I mean, could head a lot lower, but there it is. Positive divergence coming up on support. The downtrend line I'm not crazy about. I'm just going to throw that out there because we have, although there's 2 reactions there, they're in pretty close proximity, so it really only has a couple reactions. But again, if corn breaks out, wheat will most likely follow. We got a little bit of a preference towards corn right now over wheat, but I just want to share these ideas. All right, and now on to the long-term charts, or the ETNs, I should say. So there's corn. Okay, you probably remember a few weeks back, I talked about this trend line on corn. I said corn had a trend line here that if broken, I would be interested in going long. I said there's very good support. If it breaks that trend line, we're probably going to go down to 19, 17-ish. And if we do, it's very good support. And that's it. Here we are. So that was a few weeks ago. We took out the trend line. That's the uptrend line in corn. Is it the end of the bull market? Anything is possible, but I don't think so. And there was also a little triangle pattern. I thought I had that drawn. Let me add that back in. I did at one point. Maybe I was drawing it in with the drawing tools on the video, but so it was a little triangle pattern. It broke to the downside, and look, if 1917 goes, or we'll call it $19 with conviction, we can come all the way down here. I don't have support until 1744. So that's certainly a possibility. And even if that happens, and that would be a drop of about 9%. So if you're a long-term investor, you might want to ride that out. If you think, corn has another 30 or more percent upside, 9% stop loss, that keeps you within a 3-to-1 risk-reward ratio if you're looking for, 27 to 30% or more upside. But either way, it's good support is what I wanted to point out. We're not all the way oversold, but then again, we never got all the way oversold there. This thing's in a bull trend. Buyers have been stepping in aggressively. And this is that consolidation period I showed you on the 60-minute chart. So there's the case. Swing targets, I'm kind of more looking as a re-entry for trend traders. I'm going to trade actively off that 60-minute chart. But for a trend trader, you can put a stop there and let it ride. And if we take out that trend line right there, the downtrend line of the triangle, that should be bullish. And then very, very bullish if and when 2270 goes, because that's the previous highs. And just remember, a lot of these commodities, you roll back in time. Remember, they've been in a bear market. This is early stage bull market action. This is like getting in the S&P 500 back in March of 2009, back here when the stock market bottomed, because all along commodities were in a bear market. And so this is early stage bull market action. So there's a lot more upside, just to get back to where corn was trading, a few years back. And then wheat, last but not least. Wheat has, like I said, corn, I have pretty solid support there. I don't have the same on wheat. Wheat's still well above its uptrend line, and that's why I can see the potential. And a drop down to this trend line on wheat would probably coincide with a move down to that next support I just gave you on the corn daily chart. Here it's about a 5% drop depending if and when we get there. And you can see my price levels. Price support about 650 and 634. But again, we are in a bull trend, so we might not hit that trend line in a while. Last time we visited that trend line was right here, then right there, here, here. Sometimes you get away from the trend line for a while. So remember, there was negative divergence, and even in a bull market, you're going to have those divergences play out, but usually for a relatively minor correction. Gold, really no update there. I just wanted to mention it again. Big level to me, that yellow line about 1838 or so, 1840. We hit it the other day. We're at resistance. We had negative divergence. So far it's played out for a correction, but nothing big, and we're still above that key 1777 support. And so we still need a breakout above that level. That's what I'm waiting for, and that should be the catalyst for the next leg up in gold. And until then, if you get down to that 1777 level, give or take, you could certainly step in and buy. It's been support there. There's a little bit of support below it as well. Then I'll update gold if I see anything interesting. Right now, it's just kind of working off these divergences in that correction mode. And potential divergence is setting up too. If we thrust down once more to that level, we may have positive divergence in doing so. In crude oil, I'm still playing the long game in crude, and that means I'm going off this long-term chart here. This line right here, it was key support way back when, broke back in late 2015. Support once broken becomes resistance, and so the story of crude in a nutshell, as mentioned here, we rallied right up to that resistance. I believe that will mark a major top with a lot more downside in crude to come. Not just because we rallied into resistance, an extreme run, overbought, etc., but we also had, for the first time in a while, negative divergence. That's what I like to see, negative divergence, just like I like to see positive divergence to look for bottoms. And so that's bigger picture. Near term, we zoom down from this daily chart, we look at the 60-minute chart, and that's this. And so we have been stair-stepping lower. This has been and still is a profitable trade. That was that major top there. There was our sell signal, and we've been stair-stepping lower. It's been consolidating lately. You can see I added some notes here. At left shoulder, question mark. This would be a head right here. Here, let me draw it out for you. So possible, if that would be our neckline, this would be a left shoulder, a head, and a possible right shoulder. So we'll be looking for a move down, ideally on increasing volume, and then a break of that neckline. And if so, the measured target would be the widest point from the head down to the neckline. That should take us down somewhere, give or take, to either my 66 or 65-ish targets right there. At minimum, let's just say 65 would be my next downside target, especially if that neckline's taken out right there, like that. And then looping back to that daily chart, look, if crude wants to make another thrust, another run at that, that's fine. If you're playing the long game, I have to be ready for another test, just like we had back there, a couple tests of that level before the next leg down. So on a long-term trend trade, a stop should be somewhat above that level. Ideally on a solid daily close, maybe 2 or 3 closing basis is above their daily closing closes above that level. And but based on the charts, I think we'll probably not see another test. I think we'll continue lower. And then last but not least, lumber. This is 2-hour candles. Let me zoom in a little bit for you here. And you can see what's happened recently. After the divergent low, we've had a nice rally from there. Almost a perfect kiss of that 692 target that was laid out in advance. That's about a 45% gain off the divergent low. Hit that, reverse from there, and then look what we did. We backfilled. See this gap right here? Perfect backfill of that gap, and so far holding up. So this is my preferred scenario. Come on up, hit my next target at 747. But I'd probably put almost equal odds if we come on down here and hit that uptrend line I just drew, plus the 592 former target, former resistance, now support level. There was our breakout candle right there. That was the big breakout candle that took us above both this minor downtrend line right here and that 552 level right there. So that's it. Equal odds on that or that. And the way I trade, I'd rather be in it now, which I still am, in case it does this, because I don't want to miss out on this. If that happens, I'll make a decision whether to layer in a little more at that point in time. But I still think there's more upside in lumber, and part of that has to do also with the long-term charts. We look at lumber futures. Here we go. Lumber. Got on here somewhere. Yeah, here it is. This is honestly one of the best setups I've seen in quite a while with this divergent low. Big bullish positive divergence on the 60-minute chart, extreme overbought readings, all while in a bull market. Lumber had bottomed like a lot of commodities. Lumber has been in a bear market, was stair-stepping its way down from this point, bottomed back here in 2020, and is in a bull trend. And is ideally it wants to hold that needs to hold that previous reaction low, and all I can say is so far we've exploded off that level. We hit that level, we had positive divergence in place, and lumber's rallied, according to this chart, about 50, almost 56% from there, and again has pulled back and will most likely continue higher. Whether we take out that previous high or not, certainly possible. I'm still in the camp of inflation. Powell, seems to be, well, he won't let go of his whole transitory thing, and it's probably one of the biggest blunder that he or any Fed chairman is going to make in history, I believe. And you're probably hearing now, if you're reading the headlines, more and more buzz and talk about stagflation. That was that horrible beast that we had from, technically it was from the 60s. A lot of people think of it only in the 70s, but it began in, I think it was 66 or 68 and continued until 1982, I believe, was the technical span of the period of stagflation. And for those not familiar, stagflation is a hybrid of the word stagnant growth and inflation. So when you have stagnant growth in the economy, which many expect going forward based on many, many things, as well as I do, plus inflation, that does not bode well for stocks. So anywho, and what is the takeaway? Well, that's what I do this for. Let's just say we are looking at a period, a lost decade, like some are calling for, like Japan had, where we can see abysmal returns in the stock market going forward for the next 10 plus years. There's always somewhere to make money, even if you don't want to short the equity markets. Again, an inflationary period would bode well for commodities, which are not only coming out of a bear market, but are currently still by nearly all metrics in a early stage of a new bull market. And just so you know, if I'm correct on that, and we do see continue rise in commodity prices, that is inflationary by definition. I mean, that's when commodities are the food we eat, the wood that goes into the homes that we build, everything else. It all trickles down, and that puts the Powell in a very tough position, because he's maintained that he believes these inflationary forces are transitory, and therefore he's kept the pedal to the metal with the low rates, and he will have to start checking that inflation at some point when it becomes apparent to him, as well as just about everybody else, that inflation's here to stay. And then you start raising interest rates, and that's no bueno for the stock market. So just keep that in mind. And one way to look at it too, I look at it this way, is it's almost a hedge. You're diversified. So if you're long commodities and you want to, maybe you're long the stock market, you want to hold on to that trend as long as it continues. But it wouldn't hurt to have a portion of your portfolio long commodities as a hedge to your equities. And again, I'm talking long-term stuff. Tactically, that's why I do these videos. That's why I spend so much time looking at these micro levels, 60-minute charts. You can jump in and out of these things, which I have, and I tend to do with especially my active trading account. Long, short, corn, wheat, soybeans, gold, it doesn't matter. I'm not I have no bias towards any of those things in the long. Right now, I do actually, obviously have a bias towards commodities longer term, but in the near term, I don't get married to this stuff. And I'm just as willing to short corn or lumber as I am to short, the NASDAQ 100. All right, I'm going to wrap it up here. That's everything I wanted to cover. Other than natural gas, which is still at that long-term resistance. Sorry, I told you I'd end the video, but let me just tell you, nothing's changed. Natural gas had one thrust up the other day, but let me just go back to the long-term chart here, look at commodities and natural gas. I have that right here. And there's a natural gas weekly chart. Excuse me. And that's that 490-ish resistance right there. Big resistance. And that was the case for a short on natural gas the other day. And it had one little spike up, but it's still we still have those divergences in place. They've only extended. I'm going to show you that, and then I promise you we'll wrap this video up. It's been a long one, but wanted to kind of get it all out there for you. All right, natural gas NG. Here we go. So that's it. You can see DH1. This is where I laid out the setup the other day. Divergent high 1. We started to correct. We have now support about 456 right there. Hopefully you can see that line. I'll change the color. And then what we did, we had a little spike off that level the other day. It took that divergence and extended it. So we still have negative divergence in place on the 60-minute time frame. But again, major. You can't see it on the 60-minute chart, but this is major long-term resistance. So even a little spike above it on the 60-minute chart isn't going to change much on the daily chart. We need to really solidly move away from there on the daily chart, solid daily closes to take out that resistance. And based upon how overbought we are running into that level, I don't think it's going to happen. So I think natural gas is going to prove to be a good swing short, a lot like crude oil. And still looking for another move back down, just like we had a short trade here to that uptrend line right there. And if we get it, you're looking at a good 16% or so drop in natural gas from where we're at. Okay, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.